On July 27, 2007, Goldman Sachs sent American International Group an invoice for $1.8 billion, the first of the collateral calls. As the dispute ran on, Goldman also bought protection on AIG itself from third parties. By the time of the rescue, government investigators valued those hedges at slightly more than $1.2 billion had AIG defaulted. One counterparty was calling the collateral and insuring against the call not being met. AIG carried $1.06 trillion of assets and about 116,000 employees on its books. 14 months after that invoice, the Federal Reserve invoked emergency authority, and the United States government committed $182.3 billion to keep the company open. This is a forensic account of how the money actually moved, and of the single contract clause that moved it. The number you have heard is $500 billion of swaps written on mortgage bonds. At the end of 2007, AIG's written credit default swap notional was $527 billion, but only $78 billion of it referenced multi-sector collateralized debt obligations. That $78 billion is the entire catastrophe. 15% of the book destroyed a trillion-dollar balance sheet. $379 billion of the remainder was regulatory capital relief, European banks renting AIG's rating to shrink their capital charges. Over its life, that $379 billion portfolio lost $379 million, 0.1%. The dramatic number and the lethal number were never the same number. The second correction is chronological. AIG was not AAA in 2008. It lost that rating in 2005 after the accounting scandal that removed Morris Greenberg. More than half of AIG's cumulative swap issuance came after those downgrades, and the unit stopped originating in December 2005, with roughly $80 billion of commitments still in the pipeline. Selling a credit default swap is economically identical to borrowing money to buy the referenced bond. Restated that way, AIG's reported 11-to-1 leverage becomes roughly 16.5-to-1, because writing protection adds assets and liabilities and never touches equity. And because the contracts were swaps rather than insurance, nobody required reserves against them. The Commodity Futures Modernization Act of 2000 had stripped federal oversight, and state insurance regulators were barred from treating the swaps as insurance. What AIG posted instead was collateral, but only above a threshold, and in contract after contract that threshold was written as a function of AIG's own credit rating. Goldman Sachs, 4%, as long as AIG Financial Products is rated in the AA category. Société Générale, 8% on a matrix that stepped down if AIG was cut or if the underlying CDO was cut. Royal Bank of Scotland, 0, full mark-to-market from day one. Read that clause the way a trader reads it. An unposted margin balance is a loan from your counterparty, so the threshold was a free credit line, indexed to the one variable guaranteed to move against AIG in a crisis. A downgrade created no new loss. It accelerated an existing loss into a same-day cash demand. That is wrong-way risk in its purest form, the obligation to post growing exactly as the ability to post collapsed. There was a second problem. Super senior multi-sector tranches did not trade, so there was no screen price, and under the credit support annex, the calculation agent's mark determines the cash call. AIG had sold an option on a price its counterparty was entitled to define, and on a taped internal call in July 2007, an AIG Financial Products executive said the quiet part. We can't mark any of our positions, and obviously that's what saves us having this enormous mark to market. Now the curve. Before September 2007, AIG had posted zero collateral against the entire swap book. By December, it had posted $2.9 billion, by March 8.2, by June 13.8, and by the end of September 2008, $32.8 billion. The bleed ran for 14 months. Only the last 96 hours were ever televised. And there was a second engine, running inside the regulated insurers. AIG's life subsidiaries lent out bonds, took cash collateral, and reinvested it, 65% into home price-sensitive mortgage paper, against a book that peaked near $88 billion and was funded 1 month at a time. It lost $21.3 billion in 2008, and 8 of the 11 largest life subsidiaries would have shown negative regulatory capital without rescue-funded infusions. Friday, September 12, 2008. Standard & Poor's puts AIG on credit watch. The finance subsidiaries cannot roll their commercial paper, and AIG's treasurer tells the New York Fed the parent has days of liquidity left. That night, a New York Fed official emails her colleagues, "I am hearing worse than Lehman. Every bank and dealer has exposure to them. Collateral called stands at $23.4 billion, posted 18.9. Monday, September 15th. Lehman files, and the $75 billion private syndicate assembled over the weekend evaporates. That afternoon, all 3 agencies cut AIG, Standard & Poor's by 3 notches, Moody's and Fitch by 2, and the thresholds collapse. Calls jumped to $32 billion in a single session, up $8.6 billion, with Société Générale's demand more than doubling, while AIG's posted column barely moves because there is nothing left to post. Tuesday, September 16th. The Federal Reserve Board invokes Section 13, Paragraph 3, and authorizes an $85 billion revolving credit facility, secured on the stock of nearly all the regulated insurance subsidiaries, with 79.9% of the equity going to the government. Note what had not happened. Not one super senior tranche had defaulted. Lehman did not damage AIG's assets. Lehman pulled a trigger AIG had written into its own contracts. The rescue's own terms became the next problem. The rate was LIBOR plus 8.5 points over a 3.5% floor, a minimum of roughly 12%, plus 8.5% on money not even drawn, and a 2% commitment fee. Government auditors found the New York Fed did not price this independently, but adopted, in substantial part, the failed private consortium's draft term sheet, and within a day the agencies were preparing another downgrade partly because of the interest burden of the rescue itself. The $85 billion stopped the immediate run but not the mechanism, because the swaps were still open and the calls kept coming. To stop them, the contracts had to be terminated, and to terminate them, someone had to buy the underlying CDOS out of the counterparty's hands. That vehicle was Maiden Lane 3, $24.3 billion lent by the New York Fed, against $5 billion of first loss equity from AIG. On the 6th and 7th of November, New York Fed officers telephoned 8 of the largest counterparties and asked for a discount from par. 7 refused outright. UBS offered 2%, conditionally. The French banking regulator advised that, absent an AIG bankruptcy, French law barred Société Générale and Callion from accepting less than par, with potential criminal exposure for directors. The Fed's stated reason for folding is the sharpest line in the audit. Its greatest leverage, the threat of default, had been removed by its own intervention in September. Here is the arithmetic of 100 cents on the dollar. Maiden Lane 3 paid $27.1 billion in cash, and the counterparties kept $35 billion of collateral AIG had already posted. 27 plus 35 equals $62.1 billion. the full par value of CDOS, whose fair value was $29.6 billion. Government accountants traced $47.3 billion of that 62, about 76%, to Federal Reserve funding. And the concession being fought over was small. The most aggressive haircut the Fed's own advisors modeled would have saved $6.4 billion against a rescue already committed at $182 billion. Note also who was paid. The largest single recipient was not American. Société Générale received $16.5 billion in cash and retained collateral. Goldman Sachs, 14. Now hold two transactions side by side, same month, same institution. Maiden Lane 2 bought $39.3 billion of face value mortgage securities from AIG's own life insurance subsidiaries for about $20.5 billion, a discount near 50%. Maiden Lane 3 bought the counterparties CDOS at par. The haircut was applied to the rescued party and waived for its creditors. Joseph Casson ran AIG Financial Products from 2002 until he was forced out in March 2008. Congressional testimony and contemporaneous reporting put his cumulative compensation across roughly 2 decades at about $315 million, and he was retained afterwards as a consultant at a reported $1 million a month through the end of September 2008. The Justice Department closed its 2-year investigation in May 2010 without charges, and no AIG Financial Products executive was criminally charged. The consolidated supervisor was the Office of Thrift Supervision, a savings and loan regulator that reviewed the swap book in July 2007, concluded the risk was too small to be measured, and deferred. Its director later told investigators he had no idea what AIG's swap liability was. The Financial Crisis Inquiry Commission's finding was that the swaps were sold without putting up initial collateral, setting aside capital reserves, or hedging the exposure. Dodd-Frank abolished that agency, built a resolution regime for non-banks, and forced standardized swaps into central clearing with mandatory initial and variation margin, the precise thing AIG never posted. Did it pay? $182.3 billion was committed. The peak actually outstanding was about $142 billion in April 2009. Congressional Research Service accounting puts the combined result at roughly $23 billion positive, but all of it came from the Federal Reserve side of the house, including a $6.6 billion gain on Maiden Lane 3, while Treasury's equity stake lost $12.5 billion in cash, and about $15 billion once the Congressional Budget Office priced the risk taxpayers actually carried. And the underlying credit. By 2014, the Maiden Lane 3 portfolio had written down about 12% of original face, with 59% of the securities taking losses. So the book was not money good, but it was wrong by roughly 12%, and AIG died on a 100% funding demand. The gap between being 12% wrong and being dead has a name, and it was written into the contracts before a single mortgage defaulted. Collateral. Historical analysis, not investment advice.